In the world of finance, few events stir up as much anticipation and speculation as the FOMC meetings. The most recent one has left an indelible mark on the economy. Diving right in, the Federal Open Market Committee, or FOMC, under the leadership of Jerome Powell, has once again made waves in the financial world. The decision to raise interest rates for the 7th time this year has sent ripples across various sectors. Now, why is this decision so significant, you may ask? Well, interest rates are a key tool used by the Federal Reserve to manage inflation and economic growth. They influence borrowing costs, from your personal credit card interest to the cost of business loans. So when the Fed decides to hike rates, it impacts almost every corner of the economy. The sectors most sensitive to these changes? Housing and autos, to name just two. Both these sectors rely heavily on borrowing, making them particularly vulnerable to interest rate hikes. This decision by the FOMC also signifies a tightening of monetary policy, with the Fed reducing liquidity by allowing treasuries to roll off its balance sheet. This has led to a contraction in money supply growth and tighter lending standards, further emphasizing the magnitude of this decision. As we delve deeper into Jerome Powell's speech, we'll start to understand the full implications of these decisions. Jerome Powell's speech at the FOMC meeting was a masterclass in central banking communication. Let's dissect the key points and their implications. Powell's address was a testament to his firm resolve to tighten monetary policy in 2024, a decision that stood strong despite the recent rise in stock prices. His unwavering commitment was palpable as he emphasized the need for the Federal Open Market Committee to raise interest rates for the 7th time in 2023. This move, he explained, was a necessary measure to combat the persistent inflationary pressures. The stock market's performance, which saw the S&P 500 gain 2% since the last rate increase, was viewed by Fed officials as a loosening of financial conditions. This, in turn, reinforced Powell's determination to continue the tightening of monetary policy into the new year. Powell also hinted at an expected rate hike of 50 basis points. Such a significant increase will have considerable effects on interest rate-sensitive sectors. Housing and autos in particular are expected to feel the brunt of this change, but the tightening doesn't stop at rate hikes. In a move set to reduce liquidity, Powell announced that the Fed would allow treasuries to roll off its balance sheet. This action has already resulted in a contraction in money supply growth and stricter lending standards. The focus of the meeting was undeniably Powell's stance, his unwavering commitment to a stricter monetary policy, and his readiness to combat inflation. His speech was a clear signal to the markets, to investors, and to the public that the Fed is ready to take decisive action to maintain economic stability. Powell's speech painted a clear picture of the Fed's stance, a commitment to combating inflation, even if it means tighter monetary policy. The ripples of the FOMC meeting are far-reaching, impacting not just traditional markets but the world of cryptocurrencies as well. In the immediate aftermath of Jerome Powell's speech, we saw a notable reaction in the Nasdaq, gold prices, and Bitcoin. Let's start with the Nasdaq. Powell's hawkish stance and the expected rate hike of 50 basis points sent a chill through the market. Despite the Fed's efforts to cool economic activity, the anticipation of tighter monetary policy led to a contraction in the Nasdaq. This contraction can be seen as a direct response to the tightening of financial conditions and a reflection of concerns about interest rate-sensitive sectors such as housing and autos. Moving on to gold, traditionally a safe haven in times of economic uncertainty. The tightened monetary policy and the increase in interest rates typically drive investors towards gold. However, the impact of Powell's speech on gold prices was somewhat muted. While gold prices did see an uptick, it was not as significant as one might expect. This could be due to the fact that the rate hike was largely anticipated and therefore already priced into the market. And finally, let's touch on Bitcoin. The world of cryptocurrencies is still relatively new and can be wildly unpredictable. However, it's clear that Bitcoin was not immune to the effects of the FOMC meeting. Following Powell's speech, Bitcoin experienced a drop. This could be attributed to the fact that Bitcoin, much like gold, is often seen as a hedge against inflation. With the Fed taking steps to combat inflation, the appeal of Bitcoin as a hedge may have diminished. These market reactions are a testament to the weight of the FOMC decisions and Powell's words. They serve as a reminder of the interconnectedness of our global economy, where a single decision can send ripples through markets around the world. The question on everyone's mind now is, will the Fed continue to raise interest rates in 2024? It's a question that has implications for everyone, from Wall Street to Main Street. Let's dive in and see what the current data suggest. First, let's consider the state of the economy. The Federal Reserve uses interest rates as a tool to control inflation and stabilize the economy. When the economy is booming, the Fed often increases interest rates to slow down economic activity and keep inflation in check. Conversely, during economic downturns, the Fed may lower interest rates to stimulate spending and investment. In the year 2023, the Fed increased interest rates multiple times in response to rising inflation and a robust stock market performance. The S&P 500 gained 2% since the last rate increase, a sign of a thriving economy. This could suggest that the Fed might continue its trend of interest rate hikes in 2024 if the economy remains strong. However, it's not just about the economy in isolation. Inflation rates play a critical role too. Inflation has been a concern lately, and the Fed has been using interest rate hikes as a tool to combat it. If inflation continues to be an issue in 2024, we might see more interest rate increases. Another factor to consider is the impact of long COVID on the labor market. This has been contributing to labor shortages and wage inflation, which could in turn influence the Fed's decisions on interest rates. If the effects of long COVID persist, the Fed might need to keep interest rates elevated for a longer period. Despite all these factors, it's important to remember that predicting interest rates is not an exact science. It's a complex decision with many influencing factors, and the Fed's decisions are ultimately based on the data available at the time. While we can't predict the future with certainty, we can prepare for it. By staying informed and understanding the potential implications of these financial decisions, we can navigate the economic landscape with confidence and savvy.